Now let us come down to subsection 4. Okay. Now the subsection 4 says that as I have already given a brief on the connection of auditors with the board of directors and also with the shareholders coming in between. Okay. So whenever auditors give any adverse comment, okay, whenever auditors give any adverse comment, definitely the directors have to reply. So I told you already that if there are 10 comments or 10 points raised by auditors, so definitely all have to be given clarification by the board of directors. Now based on the good clarifications, maybe some of the points will be dropped by the auditors, but if the auditors are not happy on certain points, whatever the clarifications given by the board of directors, they would definitely insist, or they would definitely qualify their report, and also they will put forward the clarifications given. Now basically it is meant for now for the shareholders now to go through the auditor's report and also see the declarations or the clarifications given by the directors against the comments raised by the auditors. So now what is the learning? The learning is definitely the directors should not start thinking they can ride on anything. Okay. So auditors are definitely going to pull them in case there is anything wrong done by the directors, and similarly the shareholders, they are now going to watch also the comments, the qualifications made by the auditors in their report. So a good investors, okay, he watches, or he or she watches also the comments given by the auditors. Okay. So I mean basically the shareholders, they go through the findings, the review done by the auditors. It is required also. Okay. Now next is the subsection 5. Okay. Now subsection 5, okay, section is same, that is section 134. Subsection 5 talks about necessary certificates to be given by the directors, because ultimately how you can pull the directors, okay, it is basically based on the certificates, because they certify. So for example, in the directors responsibility statement, they certify that all the accounting policies have been consistently followed, and in case there is any changes, then they have also complied the requirements of the accounting rules such as accounting standards to take care of the changes in the accounting policies. Okay. So in that case, suppose something is noted subsequently that they have changed the policies, or they have followed a wrong practice which is not prescribed by the accounting policies, which is not complying to accounting policies, then in that case how the law is going to catch the directors. So based on the certificates, because directors, they themselves write that everything is okay, everything is correct, like they have consistently followed. So now this particular subsection talks about necessary certificates given by the directors in the directors responsibility statement. Say some of the points which are covered, like I already said you that accounting policies to be consistently followed, and the management has to take enough care to safeguard the assets. Similarly, there are other points like there is an internal control mechanism exists in the company, because accounting is basically is more accurate when there is a internal control mechanism exists. So directors from their side, they give a certificate that yes, in this company there is a good internal control mechanism exists. So now if there is a good internal control mechanism exists, definitely there is a chance that there will be less errors. Okay, there will be less manipulations. Okay, so definitely these certificates are going to make the shareholders happy. Okay, make the shareholders happy. Similarly, these kind of certificates are basically going to make auditors happy. Okay, because if subsequently anything is noted down or caught by the auditors, then in that case directors who have given certificate, they will be held responsible. Okay, so basically again this subsection 5 goes to facilitate the reliance or the belief of the shareholders and auditors on the accounting statements, financial statements. Now coming to subsection 6. Okay, so now you have understood that any document given by the board, it has to be counter checked. Okay, so like financial statement, and we have already discussed that financial statement and other supportings like notes to accounts have to be checked by the auditors. Now this subsection 6 talks about that subsequently, okay, subsequently whenever or any documents or even annual report also, whenever it is given to the shareholders, this has to be also signed, this has to be signed by them, like we have discussed in the subsection 1. Okay, there has to be 2 directors, one of them has to be MD. So similarly here also a prescribed number of people, or particularly the directors, they have to sign on any board's report or any annexes which will be now handed over to the shareholders. Again, this gives a kind of satisfaction to the shareholders or the users that everything whatever given by the company, it is countersigned, it is authenticated by the board of directors. Okay. So again, this subsection talks about there is a higher degree of reliance or the belief what the shareholders can place, because there is a signature or the counter signature by the board of directors. Okay. Now coming to subsection 7. Okay. So there has to be notes to accounts, like for example, if you open up any annual reports, HUL or any other company, so there has to be notes to accounts. And what is notes to accounts? Okay, notes to accounts are going to act like facilitating the technicalities, okay, involved. So I have already given you example, say inventory valuations. Okay, so inventory can be valued in a number of ways like FIFO, LIFO. Now the notes to accounts will specifically say this company has adopted weighted average method while valuing the inventory. So the doubts with regard to understanding of the various items or various heads in the financial statement would be clear, because there is a notes to accounts. The notes to account will elaborate on the technicalities involved in the various items reflected. Okay. Now besides the notes to accounts, definitely notes to accounts act like a what? It's like a footnote. Okay. When you look at any table, when you look at any diagram, you find every time you find that there is some footnotes given. So notes to accounts is like that. Notes to account is basically like that only. So that is going to substantiate, that is going to elaborate on the technicalities involved. Now coming to subsection 8, which is the last subsection, so that talks about the penalty and punishment. Okay. Now I already said if there is a if anything if there is a non-compliance of section 134, okay, if there is a non-compliance of section 134 from subsection 1 to subsection 7, then the company shall be punishable with fine, which which will range between 50,000 to 25 lakhs. Okay. Now every officer who are in default shall be also punishable with imprisonment for a term which may extend to 3 years, or with fine which shall be which shall again range between 50,000 rupees to 5 lakhs of rupees, and even it can be also imprisonment and also fine. Okay. Now the question is why this much of money? Okay. If you look at the earlier acts, okay, the punishment or the penalty were not so huge. Okay, the punishment or the penalty were not huge, but with the coming of the new act, now the punishment has become very severe now. So that perhaps that will scare the directors or the people who are at the helm of affairs to not to resort to wrong practices. Okay. Now while concluding, I would like to make or give you some points with regard to comparison between the Companies Act 2013, the latest one, and the old one, that is Companies Act 1956. Okay. Now section 134 can be compared with section 217. So section 134 of the new act can be compared with section 217 of the old Companies Act, that is 1956. Now if you just have a look between these two acts, you will understand that there are a lot of almost all the features, all the things of old act have been retained, but there are some additions like CSR, additions like related party transactions, additions like the board's policies with regard to appointing the directors, their qualifications, their appointment, etc., etc. So definitely these additions are very relevant, because these are the best practices. India is basically going to be developed. Today we are developing, but definitely when you are planning to develop, to become a developed country, so these good practices have to come. Okay. So I think I have cleared everything with regard to the justifications and also linking the justification with the provisions. Okay. With this I end my view. Thank you.